Could the stock market crash this year? It's a question sending shivers down investors' spines, and here's why you should care. Political tension is heating up globally, and we're seeing ripples in the world economy that could transform into a financial tempest. Now, consider the upcoming elections in numerous countries. Political landscapes have a way of unsettling the markets. Uncertainty around policy changes, from taxes to tariffs, plays a huge role in investor confidence. If you've been keeping an eye on the news, you know that fear can fuel sell-offs faster than you can say bear market. And let's not ignore the global leaders making headlines. Trade wars, sanctions, and diplomatic spats influence market stability more than you might realize. When political leaders make a move, the market often moves with it, sometimes dramatically. Are we on the brink of another 2008, or will this year defy expectations? To draw closer to the answer, we'll need to dig deeper into the economic indicators and policy forecasts tied to these political machinations. Let's explore whether this storm is truly approaching, or if clear skies are just beyond the horizon. It's not just the numbers we should be watching. The real story often lies beneath the policies. Let's take inflation, for instance. Central banks are balancing on a tightrope, tweaking interest rates to stabilize prices while trying not to stifle economic growth. Any abrupt changes can send shockwaves through the financial markets. Then there's the wild card, corporate earnings. How do massive corporations cope during uncertain times? When political shifts occur, companies strategize to protect profits, cutting costs, or making savvy investments, which sometimes leads to job cuts or expansion halts. These decisions can influence stock prices significantly, reflecting the broader market mood. And what about consumer behavior? A key driver of economic health, consumer confidence wavers with political tides. People tend to hold off spending when unsure about their future, and a widespread slowdown in consumer spending can ripple through the economy, choking growth and shaking the stock market. Strategists and analysts are constantly measuring these factors, and they don't always agree. Will policy shifts usher in stability, or could unexpected geopolitical events send us into turmoil? Remember, it's the intersection of multiple factors that could pave the way for a market downturn, or perhaps a surprising upswing. Stay informed, watch the indicators, and keep an eye on how the shifting political winds might alter the market landscape. Let's turn our attention to global trade. It's the backbone of many economies, and geopolitical tensions can put it at risk. Tariffs, trade agreements, and sanctions are not just political buzzwords. They're powerful tools that can bolster or destabilize markets. When leaders wield these tools, businesses and investors brace for impact, with supply chains and stock prices hanging in the balance. Moreover, technological changes are accelerating faster than ever, with automation and AI transforming industries. While these innovations promote growth, they also trigger market volatility as industries shift. A tech giant's decision to automate could lead to workforce reductions, impacting consumer spending and market sentiment. Now onto real estate, a sector often overlooked when examining market stability. Real estate trends can signal economic health. High property prices often indicate economic confidence, but a sudden spike in interest rates can lead to a housing slump. Housing market fluctuations have been precursors to larger economic shifts, so they warrant close scrutiny. And what about the role of social media? In today's digital age, a simple tweet can sway markets. With instant information exchange, rumors and sentiments can spread like wildfire, exaggerating market reactions and creating volatility. Understanding these layers helps us prepare, adapt, and perhaps find opportunities in market shifts. Whether you're investing, trading, or simply curious, keeping tabs on these dynamics can offer insights into potential market directions. Let's dive into interest rates, a subject that's foundational, yet often misunderstood. Central banks worldwide play a crucial role in setting these rates, intending to either stimulate spending during sluggish times or cool off overheating economies. However, even a modest rate hike or cut can ripple through the global financial landscape, affecting everything from mortgage rates to stock valuations. The challenge is that current political dynamics can put pressure on these institutions. When political figures push for specific economic outcomes, it might lead to controversial decisions that could sway investor sentiment. This is why the independence of central banks becomes a focal point in discussions about market stability. On the flip side, fiscal policies are another piece of the puzzle. Government spending and tax policies can drive growth when strategically deployed. Think of infrastructure bills, for example. These can stimulate economic activity by creating jobs and increasing demand for goods and services, often leading to a market upswing. Lastly, consider currency fluctuations, which add an additional layer of complexity. Political events can alter currency strength, influencing import and export dynamics. A weaker currency may boost exports but increase the cost of imports, affecting domestic businesses and, by extension, market performance. Monitoring these interconnected elements offers a clearer picture of the stock market's possible trajectory. It's a fascinating, multifaceted puzzle where understanding the components can help demystify potential market outcomes. Let's now explore the psychological aspect of market movements, often referred to as investor sentiment. Human behavior plays a pivotal role in the financial markets, more than we might initially think. When fear or greed takes over, it often results in exaggerated market swings. Panic selling during uncertain times can lead to precipitous drops, while over-enthusiastic buying can inflate bubbles. This mass psychology is magnified by the media, which can sway public perception and, consequently, investor confidence. A mere headline about a political dispute or economic downturn can trigger considerable market reactions. It's a reminder of the power of perception and its ability to shape reality in the financial context. Additionally, let's examine the role of institutional investors. These heavyweight players, such as pension funds and mutual funds, hold significant sway over market directions. Their strategic moves, often in response to current events or anticipated trends, can drive substantial shifts in market dynamics. Moreover, regulatory environments also influence the markets. As governments adapt to changing conditions, regulatory reforms can introduce new hurdles or opportunities for companies. This can affect market confidence as investors adjust to the altered landscape. Understanding these psychological, institutional, and regulatory elements allows us a more nuanced view of the market's potential outcomes. It's a dance between numbers and narratives where each factor has the potential to impact the delicate balance that determines market stability or turbulence. As we wrap up, it's clear that the possibility of a stock market crash hinges on a complex interplay of politics, economics, and human behavior. Each factor we've discussed could potentially lead us to a tipping point or a promising horizon. Now, it's your turn to stay informed and proactive. Keep an eye on these indicators and balance your portfolio strategically. Knowledge is power, and understanding these dynamics can help you navigate any storm. If you found this breakdown helpful, tap the subscribe button and hit the notification bell so we can continue exploring the intricacies of the market together. Let's stay ahead of the curve and make informed decisions. Thank you for watching, and we'll catch you in the next video.